Today I will be reacting to a young kid who lost $400,000, everything he had, betting through stock trading in Robinhood. This relates to stocks, it relates to crypto, it relates to NFTs, and on this channel it's all about helping young people reach their full potential. And part of that is operating in smart financial ways. Ideally, through other people's mistakes, so we don't have to make those mistakes ourselves, especially when they are very painful to make. So the story goes, this was like your typical kind of young, naive kid who really didn't get any significant financial education. He arrived in the US at 18, worked crappy jobs to get through college, then had an average job after college, didn't go to a nice school, and got paid an average amount. This is very typical. Nothing to be ashamed about this, because a lot of people live like this. The people you see on Instagram aren't, typical. And so he was 26, and at first he was off to a good start because he basically just saved up money. He just didn't spend much, didn't have much to spend, and so he just stacked money. So he saved, worked, saved, and his biggest expenses were like his car and his laptop. But I think it starts to get interesting and dangerous because he wanted something fun to do, and because he didn't like his job, he would go crazy and just love the thrill of gambling. So after a few years, he had $300,000 saved up, which is just crazy. I mean, that is insane. Good on him for saving up so much. That's the good part, and that's good financial sense. Now, that's when things start to kind of go downhill a bit. So what did he do? Well, at first he put some chump change into crypto, 3 grand, lost it all. And that was already a bad sign because back in 2017, he only had 5 grand to begin with. So it's like, how did you make $300,000 in like the last 4 years? He must have gotten some raises or something. But then he started continuing to gamble. He saw how GameStop did, and he got greedy, and he had this whole thing of fear of missing out. Now, of course, this is all lots of like speculation, and it's complex and it's dangerous, and that's like GameStop's really like a pump and dump scheme in a sense. So that's very dangerous, and most of those people are usually those who get in early and tell others to pump up the stock so that they can sell while others are pumping it up. And then it's going to crash at some point. But essentially, he bet on AMC. It went from 5,000 to 15,000. And then he was like, okay, I'm doing real good. And then he bets 50,000 on silver. I mean, this is really such a speculative market. And I think it's definitely related to NFTs. There's a lot of FOMO right now, a lot of people making money, and yes, reality will punch you in the face at some point. So then he's like, I want a safe bet. Alibaba is a safe bet. Chances are it will not fall much at all. Worst case situation, it will not fall. So he felt like, this was like, it couldn't go down. He said, worst that can happen is it goes down to 280,000. And so he bets it all. He takes all his savings and puts it all into Alibaba. And I think this is really the main part where he screws up. I mean, let's invert this situation. If you had to find a way of losing all your money, how would you do it? As Charlie Munger says, always invert the problem. And the only way to lose all your money is to stake all your money. So for him not to even have a portion of it as kind of backup savings, One personal finance rule is to have at least 1 year of rent and savings, so that if everything goes to hell, you still have that backup plan. But he didn't even have that. So like now he's working paycheck to paycheck, and he can't escape his job even if he wanted to, because he's bet it all. So that's something you should never do. As Warren Buffett says, rule number one, don't lose your money. Now, yeah, even if something seems like a surefire, blue chip, safe bet, you just never know. And so that's really his biggest mistake. But then there's a few other notable mistakes he makes. So one thing he does is he tells his mom about it. And the second mistake you shouldn't make is like, you shouldn't involve your family or friends when they know nothing about the stock market. Now, for someone like me who's studied Warren Buffett and investing and read probably over 50 books on investing in stocks and business just for fun, not to like invest or speculate, I know that, and I've learned that through learning about business, you don't want to involve people who know very little about the stock market. Why? Because the nature of the system is set up to prey on your emotions. When you see a stock going down, you are just going to go crazy with fear and say sell. And that's actually exactly what his mom did. I think every day or every week, his mom would call him up and say, get out today. Because now his mom is checking the stock every day, which is also something you shouldn't do. If you're really a long-term safe play investor, you should not be at the whims of, checking the stock every day. That's a short-term thing that preys on your emotions. And when you study people over decades, you find even the ones who choose a fund that does very well, they perform a lot worse than the performance of that fund. Why is that the case? They're investing in the same things through the fund. Well, it's when you look into it, the data, all the studies find that they always get out at the wrong time and get back into the fund at the wrong time. When the market drops or goes down, they panic sell when that was really the most bargain time to buy the stock. And then when the market climbs, they think, oh, it's too high, and then they sell. Or when it gets too high, that's when they should be selling, but they buy more because they say, oh, wow, it's gone up so much. That's a good stock. So all this is not to say to get in the stock market or any of this, but it is to say you have to be very cautious not to do anything crazy like this. So on top of that, making that crazy bet, now he has all this hassle and emotional pressure from his mom calling him every day, telling him to get back. And so I think the one good thing is that it seems like he's invested in his skills. As Warren Buffett says, the one thing that's inflation proof and it's the best investment is in yourself and your skills. So seems like he was able to make $100,000 in like a short period of time through his job. So, once you become very good at sales, it does become very lucrative. So at least he's not going to be starved to death or anything. So that's the beauty of living in the US of A. Like, no one ever starves to death here. There's still some way to bounce back. But this guy is just making more and more mistakes. The next big mistake he makes, he takes all that money he made, that extra $100,000, puts it all into Alibaba. It's like, what are you doing? He's just betting it all, like almost staking his life on this thing. By the way, like, worst case situation, another thing about resilience and never giving up is that, another story I read a few years ago is a tragic tale about a young man who killed himself because the stocks turned in the wrong direction and he ended up owing like $1 million and some change. And of course, being only like 17 years old, he couldn't pay it. You should never give up. No matter how down you are, there's always a way to get back up. I just having studied so many successful people and see how down and out they were. I mean, John Paul DeJoria was homeless at one point. He didn't give up. And seeing those inspiring stories, I would always tell myself, no matter how hard it gets, I can always, return. I can always rebound. And so just keep that in mind if you do ever screw up. But don't put yourself in these situations to begin with. You're just putting yourself behind others in terms of growing that nest egg. But anyhow, he puts in all of that. His mom is telling him not to do it. He's maxing out his account. And if he's basically living paycheck to paycheck at this point, but he still did it. I don't know what's in his head. Like, why aren't you like putting in like 20% of it? Why 100%? Like, not even a few pennies or a few $100 in case you can't pay rent. But something in his nature is telling him to be extremely greedy and risk taking. And then his mom doesn't know what's going on with the stock at all. All she knows is the stock price and it's going down. So of course, then she's screwing things up even further by saying, sell now, sell tomorrow. And then it drops even further. So essentially, I think what makes it worse is that I believe he put in some derivatives or options on this to kind of leverage his potential payoff if it goes the way he wants. Apparently, these are called call options. But the severe danger of that, and this is why you should never use leverage in these situations, especially if you're some young kid who thinks to know it all, is if they go in the opposite direction, then man, you are going to be paying a lot of money. You're using debt essentially to make this happen. And once again, this goes back to a quote from Warren Buffett and Charlie Munger, remarking on some of the associates they worked with and collaborated with in the past, and how they succeeded while some of them kind of just disappeared into the wind. And the quote goes something along the lines, this is from Charlie Munger, of, "We were never in a hurry to get rich. Some people were." And what he's referencing is that some of the other fund managers, while they were just as smart and used similar investment strategies that were long-term and value-based, they were in a hurry. So they used leveraged debt, which kind of magnified their bet. But if the stock price went in the wrong direction, man, you were in for some hurting. So essentially, long story short, it went really bad. Alibaba, over that time, lost half its stock price. And then he got very depressed and he felt very messed up and stupid. And his mom told him off a couple more times, but like knew he was already like in this depressive spiral. So she kind of laid off him as well. And then he learned a valuable lesson and shut down his Robinhood account and walked away with $20,000. So, he concludes this story by just saying how he's kind of screwed over, but he met this guy in his 50s who did something similar and then kind of, recouped his life essentially, and, still found a way to live and survive and make something of his life, even though he had a tremendous tank in his savings. So essentially, this is something that tons of people go through, and it's such a tragedy that they still don't teach personal finance classes in school that teach this. And so unless you go out of your way to stumble across it through a YouTube video like this and read good financial books like Richest Man in Babylon or Rich Dad Poor Dad, and even some of those books don't really cover it in detail, then you're in for some hurting. So that's such a pain. And he also says here that he doesn't believe in passive index investing, and I don't think he really elaborates on why. But whether or not you believe in that, one thing's for sure, and I think he would agree with this, this maniacal way of investing where you're just betting it all is just not the answer. And I think everyone has different issues, and I'm not going to elaborate on why I think the long term uh, index approach is good, but I will discuss how ridiculous this any approach where you're betting things that will physically harm you and your livelihood uh, to get rich quick out of greed can have an impact. So yeah, maybe that's something that you should take away from this. And I think the one other thing I want to add here is that a lot of these things are set up for young people to entice them, and since they're so naive, they can lose a lot from it. So one of the lessons that is not new, it's been repeated many times, is you know only bet what you're okay with losing completely. So that's something where, let's say, for me, I invested a good portion in Pokemon cards over the last couple of years, but um, if I lost it all, I mean, it would still be like less than 5%, less than maybe even 3 or 2% of what I have, and so it's not going to kill me or anything. Uh, and so that's something that you can kind of think about and understand, because you just never know. You never know. And he discusses circle of competence here, which is another Warren Buffett principle. But essentially, it's like, don't invest in things that you aren't competent in and that you understand. And for him, uh, you know, do you really understand what Alibaba as a business sells, what its infrastructure is, why it's trading at that stock price, how to calculate the market cap and their free cash flows and their earnings, and figuring out if that's a good price to earnings ratio? Essentially, just assessing if that business is really earning enough and will be earning enough in the future without leaps and bounds of optimistic estimates to be trading at what it is. And that's just a bare fundamental thing, and unfortunately he most likely didn't. It was due to maybe ego, greed, and I honestly don't judge him that negatively, because I think compared to some of the people in the NFT space right now, it's like it pales in comparison. And I think right now it's a large run up, but there will come a reckoning at some point, and I do believe in the utility of NFTs. But there's a lot of speculation going on in that world as well, and a lot more FOMO in that world. Uh, so what's he say? He says, at the end of the day, I was stupid enough not to diversify, but I don't think Robinhood is a net positive for society. And then he goes on this kind of, tirade about Facebook's addictive nature and gamification and whatnot. But that's just kind of how it is. And I think another part of it is when you win, you don't learn lessons. So when the stock goes up, when that NFT goes up, you don't learn anything. All it does is fuel your ego, and you think, oh man, I'm pretty good. It's only when you fail, or you take some time to reflect, learn, be humble, learn from mistakes from others, and question whether you really are as smart as you think, or this is all just a bunch of luck and a bull market. And so that's really where the issues are. I think even for myself, I am very tempted and curious about the NFT space, but I also see a lot of hype, a lot of uh, things that are not really substantiated in fundamentals or uh, solid business or cash flow. It's just like, you know, people preying on others and hype, and oh, this new collection has something unique, and that's very dangerous. So he's saying that, he's learned something from this, and, what if he waited when that money was 2 million instead of 300,000, and he made the same mistake. And I think, he it's important to kind of learn from your mistakes, and it's human nature to take lessons out of your pain. So I think he did learn something very useful. Fortunately for you, you don't have to learn it in the same way. And I do think this is so much more common than you might think. I think James Altucher, a famous podcaster and blogger, is another great example. He's often talked about his story about how he thought he was such a hot shot because he made millions of dollars through like investing. Then he invested it all into the dot-com bubble, and it went to zero. And because he put it all in, like he came out with zero, he had to move his daughter from the city to like the suburbs and to a much worse off educational system because he couldn't afford it anymore. He bet it all. So it's just such a tragedy. And I mean, this one's really kind of about diversification, and I think people understand that, and they're like, okay, I get it, but it's there's more behind it than just that. It's not just about diversifying and not putting all your eggs, every single one of your eggs into that basket. Uh, it's also about really just realizing that, hey, anything that's get rich quick usually takes a lot longer than that, or is a scam.